Now, you might think you already know what I'm going to say in this video or in this episode, that savings accounts don't give enough interest. They aren't even keeping up with inflation. So I'd be losing money in a savings account when I factor in the time value of money. And that's why I don't use a savings account. And while that's true, that's one of the factors. That's not the main reason I don't use a savings account at a bank in order to save my money, except for, a very small buffer that I want in case of like really big emergency. But low interest isn't even my top five of reasons I don't use a savings account for my savings. I look forward to sharing with you my top five and the alternative I found that solves all five really super well. Welcome to the FIFE Movement. I'm your host, Amanda Neely. This is the only movement that helps our generation create our unique feminine and entrepreneurial path to financial independence. Be sure to subscribe and hit that bell if you're watching on YouTube so that you don't miss a future episode. Okay, first, what you need to understand before you can really get these top five reasons I don't use a savings account to save the majority of my money, you have to understand the journey my money takes if I were to deposit it in my savings account. So let's say right now I decided to move $100 into a savings account. I just had this $100 bill and I put it into a savings account. Now, like you, everything's electronic, so there's not really a $100 bill that's moving. But for the sake of taking what's really an invisible process and making it more real for us, pretend it's a $100 bill. I wish I had one that I could hold up. I don't even keep cash anymore either. But so what happens to that $100 bill depends on the bank's assets, but let's use the big banks for this example. They only need to keep 10% of my $100 on deposit. The other 90% they can and usually do lend out. So the bank can take my $100 and lend 90 of it to someone else, only leaving $10 in the vault. Um, and that's not that big of a deal until you think about how banks are connected. The person that received that $90 might spend it at a business that then deposits it into a different bank. And then that bank can take the $90 that was deposited and leverage it to spend or to lend $81 out to another person who then gives it to someone else and they deposit it in the bank, to bank three, and then bank three takes that $81 and lends another $72.90 to someone else, and so on and so forth. It can go all the way down the line to 90% at a time. I did the math. I'll show you on my screen here real quick. I found that if you take that 90 and you just see like what happens, um, here's my $100 going in. Here's how much stays in the bank. Here's how much gets lent. And then at bank two, if that $90 is deposited, how much they keep, what gets lent, and so on and so forth. I just copied the formula down. I got out to 73 banks when it was like half a penny. And I was like, I better stop there. But they were still lending out a nickel for that. And it basically, when I add this, just sums up, right, how much money is in the bank and how much money is lent from the bank using that formula. And that means that potentially my $100 becomes almost $1,000 through the system of how it travels from the bank and through the system into people's hands, back into other banks, and so forth. So can you imagine what happened to the $250 billion with a B that was part of the bank bailout of 2008, where they created this cash infusion of $250 billion to go into the banking system to do what? To facilitate and encourage bank-to-bank loans and other types of lending. Now, let me share my screen again, just because this is really fun. If you want to see this, if you're watching the YouTube or listening to it on the podcast, you want to see these numbers, check out the YouTube version of this. But just for fun, let me put $250 billion. So there's my 250 and then millions, oops, thousands and hundreds. So I got a lot of zeros in there. There's my 250. Did the same thing, just going out to 73. They could keep going from here, but 73 banks later, that 250 billion, here's my hundreds, thousands, millions, billions, trillions. It's become almost $2.5 trillion. That's really what happened with that bank bailout that happened back in 2008. Now, what I'm curious is if we looked at 2020, and remember how like every taxpayer received $600 this year? And a lot of people just put that into a savings account at a bank. And then the banks leverage those things, leveraged 90% of that. Um, and also at the same time, I'm not 100% clear on this, so have to talk to a well-versed uh, an interpreter of how our laws are written and interpreted. But it seems like maybe that same act, that CARES Act that gave us that $600 per taxpayer, may have also loosened that 10% reserve restriction. So they might be even leveraging it even more right now than previously in past iterations and past times with banks. But I mean, you can just imagine what's happening. Now, so now you've kind of seen what's happened with money deposited into a bank. $100 becomes $1,000 as it moves throughout the system, and this journey that it goes on. And now I'm ready to share with you my top 5 reasons why my savings doesn't live in a savings account. And it all has to do with this journey. The technical name for it is fractional reserve banking. If you want to Google it and learn more about fractional reserve banking, that's what it's called. So the first thing that really irks me that fractional reserve banking does is it increases the ability of banks to create loans, whereby they use my money that I put in there to enslave borrowers. I mean, people are in so much debt. Literally, I think about a third of Americans' money currently goes to paying off debt. And by saving, I'm enabling that to continue. I'm enabling more and more bondage to debt. The more and more I save, it allows banks to create more and more, or at least save within a bank, right? So I don't want to be part of that system. If I'm not saving in a bank, that bank can't keep giving out those fractional reserve based loans to other people, and those people pay interest, right? And so forth. Also, with this expansion of the money supply, where there was really only $100, but through this fractional reserve banking, they've created $1,000, right? Multiply that across the entire society. There's more money out there than actually exists. And because there's more money out there, the money supply being increased also leads to an increase in prices. We pay more for goods and services the more money there is, right? That gallon of almond milk that I buy, or how much I pay, get my hair cut, those are all impacted by how much money is out there in the system. And so when I'm adding to my savings account, I'm actually increasing the amount of money that I'm going to pay for my next, maybe not for the next, but over time for the gallons of milk almond milk that I'm going to buy in the future. Right. So, I'm also not cool with that. I don't want to save in a savings account and see more and more of that happen. And then kind of going back to the interest that people pay on the loans that are given right when the money leaves the bank, I wonder who's profiting off that money. I know I certainly am not, because of that low interest that savings accounts have. And I'm of course not against people being profitable, but I am concerned about how that profit is distributed within the company, right, as they make it. It's typically given to the stockholders or the executives, while the janitor, the teller at the bank, they struggle to see their wages increase, and they're constantly struggling to feed their family while others are profiting. And so I don't want to be part of that kind of system either, kind of what's happening internally at the bank with how they're making money and then what they're choosing to do with that money. Might be a little different at a credit union or something like that, but we're talking about banks here, right? So then we've got number 4. Really, when you think about it deeply, fractional reserve banking also drives a lot of these booms and bust cycles, right? If you've got increased debt because banks are out there trying to get people to borrow money from them because they've got all these deposits that they need to put to work. If you've got high prices because the increase of the money supply has made the prices go up, and you've got huge inequality because of how banks are distributing their profits, right? And taking advantage of people that need loans and things like that. Aren't those all key drivers into the boom and bust cycle, into the economy and the stock market having these huge ups and downs, right? Don't we like 2008, right? It was a lot of people taking out debt to buy homes that they couldn't really afford, and the home value goes down and they couldn't figure out what to do, right? And then the prices were high, and so that made it even worse. You can tell probably I'm really passionate about this. Those are big reasons why I don't save my money in a savings account. Now, so those are the first 4. Number 5, you might be wondering this whole time, how safe is the money in the bank really? Right? Isn't that why you save in a savings account? Because it's safe and it's secure. And if that $100 has become almost $1,000, there's no way everyone can get their money at the same time. So, how safe is it really? Right? And I think you're totally on track with asking that question. That's why we have the FDIC, basically insurance for the banks in case everyone wants their money at the same time. But if you look at the FDIC's website and right on their homepage, you can read that they have 114.7 billion in their deposit insurance fund. That's how much money they have available to rescue banks in case everyone goes and gets their money at the same time. And then you can go to their quarterly reports right there in their website. And the last data available as of this episode's publishing reads that their insured banks have that, so that it's listed in billions, 20,254 billion, which translates to $20 trillion and then some. Now, the math there, if you take the FDIC's fund and divide by how much the banks have that fund is meant to secure, that means the FDIC only has 0.57% of the funds they are insuring at the ready to fund your deposits if your bank goes bankrupt or if there's a run on the banks. Less than 1%, 0.57%. Now, I don't know about you, but that doesn't seem very safe to me. I mean, maybe they should call them risk accounts instead of savings accounts. So, but what are you to do? Just put your money under a mattress? That might not be the best idea either. But I think there are better alternatives to keep your money safe. And I referenced this idea in the last video, but I can tell you what I do. You can choose if you think it might be something you want to look into. Just keep an open mind here. I joined with millions of other Americans to pull my money in a cooperative style financial product that exists outside of the fractional reserve banking system because this product is not offered by a bank. Now, hold on to your horses here. I'm about to drop a term that will turn a lot of people off because they think they know what it means, but stick with me for the duration. Your definition might change. My savings is actually held by an insurance company, a life insurance company to be specific. Now, insurance companies are very heavily regulated by state law. So different states have different laws. Yours might be a little different than mine, but they're likely similar because they're based on logic and common ideas and stuff. But each state requires every life insurance company doing business within that state to keep what they call statutory reserves, which is a fancy way of saying they need to be able to make sure they're able to pay whatever future claims they have, right? If it's car insurance or home insurance or life insurance, they have to be able to pay claims on whatever or whomever they are insuring. And state insurance regulators enforce minimum levels of liquidity, accessible cash, that insurance companies must maintain in order to fulfill those claims, right? If everyone's house burned down, the home insurance company would need to reimburse those people for the value of their home. They got to have money available for those things. And as of the end of 2019, the life insurance company that holds a majority of my savings, I do work with a couple different ones, but the one that has the majority of my savings that I've been working with the longest, they have a surplus of over $2 billion, which means they can fulfill all their financial obligations to their members and still have $2 billion left over. And that's billion with a B. And by participating in this arrangement, members like myself are able to avoid going into high interest overbearing debt when we have an emergency or opportunity. I did that when I had a big flood in my business, right? We can keep the money supply in check by not creating more and more money, right? We're not doing fractional reserve. And when the company profits, we all profit mutually and somewhat equally, as we're all doing well together. And we can know our money is relatively safe and secure from those booms and busts. And we know that there's plenty of in case we all need our money at the same time. And then actually on top of all those things, there's a safety net called reinsurance, where if for some reason the life insurance company can't fulfill its obligations, they have their own insurance to cover it up for them, or like to cover up, what they can't fulfill. That's pretty cool, right? It's exactly these reasons why I'm not thinking about the rate of return or how much interest I'm getting on my money. And yes, I'm getting more over time than I would just keeping my money in a savings account. That's pretty easy to do at this point, but it's way bigger than that. There's so much more to the story than just rate of return, APR or APY, interest, that kind of thing. And you might be wondering, well, why don't you just use a money market account or an index fund to do something similar and get bigger growth, better growth? Well, you're in luck. I'll share that in the next episode. Yes, index funds, everyone's putting their money together, they're helping it grow, they all benefit. There's a few things you might want to think about there and how it's different. And also, I want you to remember today that we're in this great transition as a society, and the change you wish to see happens one household at a time, and it makes the grand solution easier. And I feel like I'm being part of that change by pooling my money with millions of other households, and we're creating the solution for ourselves. I think you owe it to yourself to see if that's the right thing for you, but only you can do that. And while working with a qualified professional to help you do that really well. For now, thanks for joining me and connecting with the FIFE movement. As you go about your day, remember, wealth is coming your way. Your quest is to prepare for using it well. For more tips on how to prepare, be sure to subscribe. And to connect with the community, visit fifemovement.com. If my gift has helped you today, please pay the gift forward by sharing this content with a friend. My gratitude in advance. To help this video be seen by more people, please hit the like button. We invite your feedback in the comments as well. Remember, keep an open mind. Ask first to understand, then speak to be understood. I look forward to hearing from you.